Hey, good afternoon, everyone. It is 2 o'clock on Wednesday afternoon. There was quite a bit of trade action today, so let's go through and talk about it. From a fundamental standpoint, not a whole lot of new fundamentals to talk about necessarily, but certainly price action today was telling. So, what I've got in the charts before you here are I've got July corn over here and I've got December corn over here, okay? And I want to show you the similarities and the differences between these patterns. And I think that it's pretty important. Now, as to December corn, we've been looking at this bullish divergence right here as well as bullish, right? And as reasons to lift hedges and move on up the chain. And we've been looking at this day right here as the go signal, as what we would call a major day, because it took out the low and the high of that prior day before it, and it also took out 1, 2, 3 prior closes. And so that was a big signal, enough for us to say, hey, maybe we're not looking lower, we're going to look higher for a little bit. And today's price action, what it ended up doing is giving us the exact same signal in reverse, with the only exception of this long tail here. So what we ended up having is a day where we took out yesterday's high, and we took out yesterday's low, and we took out the day before that's low, and we stopped right on top of our hedge line, and we fell out the bottom of our daily cloud. And so that to me is a sell signal. So we went ahead and moved back to a hedged position in December corn, because that's what we talked about what we would do, right? We'll give it some length and hopefully we can improve that position. But if we fall back out of our daily cloud and back to our hedge line, then we'll hedge it again. So exactly what it did, and that's exactly the action that we took as well. That's just fine. And something that is helping support that argument is this chart over here, which is July corn. So remember, a lot of the strength in the corn and bean market is being led by the old crops because of the tightness in western Kansas and the tightness of last year's supply. And so there's been this tension between that tightness and the perception of looser supplies or abundant supplies coming in the fall. And at some point, this thing's going to roll over and work lower. Certainly, we've been in that camp for a long time, thinking that carryouts were going to ultimately grow, but we're so tight that we can't rule out a move higher. So we've been working the long side here, hoping to improve on things, but with new crop being as weak as it is, and then this signal here, I really don't like at all. Now, this isn't enough to dump everything and run to the hills and short it, but it's definitely the first step in that process. We did not take out yesterday's high, but we did have a bearish engulfing body, which is the green part and the red part. Those are the full bodies of a candlestick. And today we have a bearish engulfing body, and on the December we have a bearish engulfing body and an outside bar combination. We did take out and close below yesterday's low in July corn, and we closed just barely inside the top edge of that cloud, and we did also take out 2 prior closes. Now our hedge line is all the way down here on July corn, so corn could reverse and move higher here because our deference is still to the upside, but we're nervous enough about it, and we think that the downside is big enough. We went ahead and exited length in both July and December contracts today. And we're going to just hold that position until we're able to work back up out of this cloud and back up out of this one as well. And another thing that we didn't like at all is this divergence on the stochastics here on July corn. If this was going to be a new high, then we should have seen this poke on up higher, and we should have seen strength coming up here. Now, unless we get until we get follow through down lower and we see this thing really roll over, we can't rule out that we'll bounce and go on and nullify that divergence and make new highs. But for sure, the reading today is if this low breaks away, then look for a retest of these lower lows down here. And if we break out the bottom of that cloud, then certainly I would look for a retest of the lows down here at 596 in July, and ultimately the lows in December down at 547. And if we break those, I don't know where exactly we go, but significantly lower in our opinion. Remember, we're looking at a balance sheet that could swell above 2 billion bushels. That's not bullish. In no matter which way you cut it, that's not bullish. In order for us to go a lot higher, something has to change drastically to keep that carryout from growing, whether that's drought, planting delays, prevent plant and fewer acres, whether that's some sort of a big weather event that decreases yield, or some sort of new demand coming online that uses more than the USDA says we're going to use. Something like that has to happen, and we don't see that currently on the radar. In fact, the fundamentals as we see them really get weaker, but that's okay. We're okay taking shots to the long side, even in that environment, because we know that that markets don't go in straight lines, and that they may come and that they may rally even then when it doesn't make sense. So I think we've been clear about that all the way for the last couple of weeks, that we are not sure exactly why we're rallying, but it looked like we're going to. And today is a reason to think that that's done. So we're gonna take a step back out of the bull camp, go to neutral for just a second, and in all likelihood, if we see further weakness down out of these clouds, we're going to turn back bearish, and we're going to want to sell this thing pretty heavily. All right, now what about soybeans? Soybeans did not help this argument at all today for the bulls. Here is new crop soybeans. We have almost a bearish engulfing day, not really, because it didn't take out any highs or anything like that, but we definitely have weakness. And we are also, get our cloud on here, we're also trading below our daily cloud. We've traded back below this upper boundary line, and our hedge line is headed straight down, right? So sometimes we'll chase these, and a lot of times when you chase a trend line like this, you'll just break it and you'll head right on down to the new lows. So new crop soybeans definitely looks like it is something that is trying to roll over. We thought that this was a major low, but the market seems to be fighting that pretty hard. So I think that this is now resistance, and anything below that needs to be sold. And we need to be looking lower here. Supporting that is also the new crop action or the old crop action today. And again, we've been looking for higher prices here, but we haven't gotten them. And so, we thought we had them, but now the market took them away from us today. Put the daily cloud on here. So what we ended up doing is testing the bottom side of this cloud and then immediately pulling away. And what can end up happening out of this setup is that we come down just a little bit more, and we keep grinding sideways until we bounce off the bottom of this one. That's possible. So, we don't have to go straight down, but I think the most prudent action on this is to stay out and stay to the side, because further weakness will put pressure on the lower end of this range, which will open the door to much lower prices. And if corn breaks, then there's no reason for beans to stay up here either. So beans could get really weak really fast if we're not careful. So it's been fun playing alongside of it. It's been worth it, but we also need to be realistic that this carryout is growing too. Now, a couple other things that I want to show you have to do with Kansas City wheat. Kansas City wheat was off hard today, and I think that corn is going to really follow and gauge what Kansas City wheat does and what Chicago wheat does. And I'm going to spend just a minute talking about why. So just because we're talking about wheat, guys, don't turn us out if you're a corn farmer, because I think this is significant and important for you to think about. So wheat rallied here this week right up to this resistance level, right? And then it immediately sold off and retreated. We took a long position right here today. I think we bought it right here at 57, and is where it was when we sent our text out. And we said, hey, we want to buy it and see if this low holds. Well, it doesn't look like it's going to. In fact, it looks like it's going to go ahead and roll over and go down. But it's okay. I like taking a shot at that here because that was very impulsive, and this has been a very kind of weird sell-off where it's just sort of just leaking lower, which would be counter trend, and it's above our hedge line. So buying it and putting a stop, at this low or down here, I have no problem with at all, thinking that this is an impulsive move. We've got a little corrective pullback, and now we need to bounce and take another run at these highs. I really like that setup, and I still do. But if corn is going to break and whirl over and go down, and Chicago is going to break down, then I think Kansas City is going to go with it. And here is why. This is a monthly chart of Kansas City minus Chicago. So we're comparing two week classes here. And this goes all the way back to the origin of my charting software here, which is April of 1976, and it goes through today. And what's interesting about this spread is that we went from in November of 19, we went from the all-time cheapest values of Kansas City wheat versus Chicago to all-time premium here today. And so there's a lot of assumption that Chicago wheat, or that December wheat, needs to come down and Chicago needs to come up. But the issue is that if the underlying reason behind the strength is we're too short corn and we can't feed it, we can't feed Kansas City, and the world needs hard red winter wheat, so we have to put premium under it, then a rally in Chicago, which looks like this, really isn't bearish Kansas City. Because if this is going to rally and the spread doesn't need to narrow very much, then Kansas City can leak higher with it if this gets impulsive. And we like this Chicago setup for obvious reasons. There's a 5, there's a 13, there's a triple bottom right here. Today was really weak, and this is where some of the weakness came from in Kansas City, because it was just trying to keep that spread consistent and trying not to let it get too much wider. But if Chicago bounces because of these divergences that are in effect, and I can put all of these lower indicators on the screen for you, massive bullish divergences across the board. A reversal from here could get explosive in Chicago, which, because of the way this spread is acting, would begin to narrow it. And if Kansas City, that would limit Kansas City's downside, in our opinion. When you're trading a spread, you can sell the higher end or you can buy the lower end. And some traders like to do both, but you don't have to. You can actually just trade one side of it if you think that one side is going to gain on the other. And so just because that spread may be bearish, that's not necessarily bearish Kansas City wheat if it's too bullish Chicago. I know that sounds kind of circular, but just think about that for a minute. If Kansas City is short and doesn't have sufficient reserves to meet either demand or dealing with a weather issue, which we have, then and Chicago starts to rally, then Kansas City's not going to break very much, and it's going to actually go higher with Chicago. So when you look at this Kansas City wheat chart, it actually looks to me like we could see a lot of strength in Kansas City if Chicago starts to go, because that spread can get wider or narrower with them both traveling the same direction. So the better way to play that spread might actually just to buy Chicago, or to actually step in and buy both, and understanding that one of those two legs may work with each other. And I think we've seen the funds do that with their relative positioning, because they've gotten really short Chicago, they've gotten less short Kansas City, but they haven't really gotten overly long either. So they could push both a long way if they were to get bullish. Now, if corn falls over and just kind of dies, this is the same spread chart of Kansas City versus corn. You can see we're right mid-range with where we've been for the last 40 years. So if corn goes much, much lower, the spread gets higher. If wheat declines relative to corn, then we start to feed it. So Kansas City really can't break much against corn. it really can't break too much against Chicago, assuming that we have plenty of supply, assuming that we have tight supply. And so I think that they've both got to rally, which is super weird given the time frame that we're in, which is why we wanted to take this long position right here. And we may be dead wrong, and it may bounce right back on up, and we'll have to buy it again, and that's just fine. Here is what the cloud looks like. You know, we've got a lot of places to tell us where we're wrong on this position before we really need to get too worried about it. So I think we'll nurse this one just for a little while, and we'll see how it develops and how the trade unfolds. But spread trading is not quite as simple as just buy one leg, sell the other leg, and walk away and call it a day, because they can do some weird things. And a market that is that you think is acting irrational can do that a lot longer than you can stay solvent. So you got to think outside the box, and ultimately we want to just go with our system. So we had this big impulsive move up. Our hedge line started to move higher. We're above the cloud. That's a go for us all day in order to buy strength up above that, right? If we break down here, hey, that's fine. We'll sell it, and that's something that we want to be quick to do if these lows right in here are violated and we give up this cloud. All right, that's 16 minutes. A lot of action today. I know that that's a lot of stuff to cover, and it seems like we are kind of going from bullish to bearish here, and we're really not. We're just following price. We're trying to listen very carefully to what the market's telling us. We're trying to be completely objective about it, and we don't and trying to really not care whether we go higher or lower. We just want to make sure that we're with it when it does, and that's just fine, because ultimately our job is to defend against lower prices, which is why we went ahead and sold and re-hedged new crop corn today, because we're just not going to take the risk that this thing falls out of bed and gets out away from us. If we have to rebuy it up here, that's just fine. You know, that's higher prices aren't going to hurt anybody, so we'll deal with that as it comes. Remember, there's risk trading futures and options, and you should only do so in light of your own financial condition. Hope you guys have a great Wednesday afternoon. We'll talk to you later.